Well, good afternoon, good evening, good morning, wherever you are in the world. Welcome to our latest in the series of webcasts on global processes. And today we're talking about the intercompany process and this idea that many of you actually have an intercompany global process owner and what the challenges in this area are. So I'm Dan French, I'm founder and CEO at Consider Solutions. Very pleased to host this session, and I know many of you on this call, so thank you. Very pleased to welcome Steve Standring, who's the Global Head of Intercompany at Blackline. So welcome, Steve.
Thank you, Dan. Looking forward to this.
Good, me too. So let's get straight into it. It's a 30-minute session. We're going to be trying to be careful with your time. So a little bit of introduction from me, a little bit of discussion around the intercompany challenge and context. I'm going to ask Steve to talk from his experience about transforming that global intercompany process and what's the opportunity and what are some of the strategies. And then I'm going to come back and talk about processes and journeys, governance, data and digital, and how that all comes together to help us move forward into the new world. And a few thoughts for the road, and we'll have some Q&A at the end. You can ask questions as you go through, so it's best to answer questions as soon as they come into your head. There's a Q&A panel on your GoToWebinar interface. Pop the question in there as soon as it comes to your mind, and we'll deal with it at the end. Any questions I don't have time to deal with, we'll get back to you by email. It's worth doing. It keeps us all focused. It makes these sessions more useful and more refined. So please ask your questions. It's key. So moving along. So many of you are very specifically focused on intercompany. Many of you are record to report subject matter experts where intercompany is a part of your remit. But also there's quite a few of you on this call who are finance leaders, GBS and shared services leaders. And it's kind of interesting and important for us to recognize, the context within which we all operate. And I like this survey we did a little while ago. There were a number of elements to it. And this isn't about the expectations. This is about the aspirations of leadership as individual professionals. And I like this because they're kind of really telling. So the 5 big priorities were to develop and enhance reputation as a value creator as well as a cost reducer, because we can't cost reduce our way to success, which is important to remember, although cost reduction is always a key. That's why it's as well as. This idea of becoming a center of excellence to optimize and automate as well as operate, which is absolutely key. That's a continuous improvement idea. There's end-to-end business process, alignment, collaboration, integration, ownership piece, which we will touch on today as well. Digitizing, integrating processes, again, a topic for today. And if you do all those things right, a byproduct of that is you're going to have a talent pipeline for the entire business, which is, of course, a mixed blessing because you don't want to lose your people, but it's still a wonderful place to be, that you become the talent source for everyone. So intercompany, a lot of people regard it as a bit of an obscure but painful process. There's a lot of reasons why we need intercompany in global businesses. There's all the issues about transfer pricing. There are rules about how you can price services and intellectual property and goods between organizations, between tax regimes. We all have those transfer pricing models in place. You've got recharges, internal services. How do you allocate costs globally? How do you get true customer and product profitability when you've got a global supply chain and global product production and global sales and marketing? There's regulatory requirements and specific tax positions in certain regions you've got to make sure you support. The M&A point, as you bring in businesses, you've got to work out how you operate with them as you integrate them into your organization. And then there's the whole idea of purchase aggregation. You might want to purchase globally in one place and then recharge internally. And royalties and transfer pricing I've talked about, and ultimately get a global access to the capabilities of the organization. So it's a key part of an organization's strategy to deliver value to the customer. And as a process, what is it? A lot of people think about it's just about accounting and reconciliations, but it's far more than that, as you can tell from the why. It's got a big impact on everything from revenue to costs to tax, profitability, working capital, the whole thing. And as a sheer engine of activity, for most global businesses, it's a very high percentage of your finance transaction volume, and it's a surprisingly high proportion of your transaction value if you consider the movements between operating companies before your goods and services get to the customer. So a lot of this you can see yourself, but it's a very big gap between the best and the rest, and there's some key things we've got to do. And automation is key, but we've got to understand the process and build transparency, eliminate waste, and simplify this as a process if we're going to get the develop business to our natural aims. So these are the big 5 challenges that everyone is flagging up about what's making intercompany so hard to do. A lack of a centrally integrated single point ERP. Obviously, for most organizations, if you don't have a single instance, one ERP worldwide, that's going to limit transparency on detailed data. You get consolidations, not the detail. The compliance obligations, the audit requirements, the documentation requirements, and the sheer scale and value of the variances we get. These are the big 5. It's a big, big challenge, and I know those of you here can identify with that. So, keep you involved. I want to ask you a couple of questions, very simple, just so you know who you are and who you're with. So this is very simple, just 1, 2, 3, 4, or 5. Would you self-identify as shared services and GBS, or procurement? Number 3, finance. 4, ITRS, or 5, other. Just select one of those. What do you identify as? Should be very simple. And then you'll see what company you're in. Let's see where we're at. So 1, shared services and GBS, just type 1. If you're in procurement, type 2. If you're in finance, general finance, type 3. If you're ITRS, type 4. And if you're in none of those, type 5. Let's have a look at the old scoreboard. So we have, okay, finance and shared services GBS with a healthy selection of other. Okay, well, thank you for that. So you know you're in the right company. That's good. So we talk about intercompany as a process, and we use a lot of phrases which we kind of bandy around and assume everyone knows what we're talking about. But I would bet you that if you talk to a few colleagues in your organization and just say, what is a business process to you? What do you mean by the term process or business process? And you'll get several different answers, and the obvious answers are at the top. But when you start to think more about it, there's a lot more nuance and subtlety about it. It's about habits and behaviors. How do we use the various systems and technologies, the policies, everything else to achieve the outcome? Is it an end-to-end value to a customer, internal or external? Does it bring value? And the experience of it rather than just the mechanics. It's a lot, a business process is a complex concept, more complex than we like to assume. So I'd encourage you to think about that. And of course, end-to-end cycles, intercompany, you'd expect an intercompany cycle to look like this. From the left-hand side, the definition of strategy, why do we have intercompany, where are those company operations, setting up the contracts between companies, allocation approval, invoicing and mirroring that between AP and AR, and close reconciliation reporting, and lots of stakeholders as you'd expect. But intercompany doesn't sit alone, no process sits alone, but it does sit at the nexus of all the key finance processes for sure. Customer to cash or order to cash. You know, the key part of this in most organizations will involve intercompany as part of your supply chain. Again, on source to pay, the same issue. So these processes interrelate. And record to report, clearly a lot of you regard intercompany as closely related to that because of the reconciliation and settlements and reporting issues. So when we talk about end-to-end, why do we worry about end-to-end process rather than just the reconciliations, for example? And it's kind of interesting to think about this because we all think we believe that end-to-end is a good thing, but it's not always obvious why. And I think it's important to recognize that a silo mode of operating has always been it's always been wasteful. And to be honest, we might be late in seeing this because the manufacturing industries have got this, they've worked this out. Automotive worked this out a long, long time ago. But this idea that silo efficiencies might drive unintended consequences upstream and downstream. In fact, it does. They invariably drive unintended consequences upstream and downstream. You get misaligned performance measures between the silos, so you get tensions. The customer experience or supplier experience isn't great, and you get suboptimal business outcomes. So that's why we want to do it. That's why we want to think end-to-end, and that's why we need to think end-to-end with intercompany as well. So if you use the global process ownership as a strategy, or if you're just involved in an end-to-end process like intercompany and trying to get these big things done, whatever your aspirations are, execution's hard, right? So you don't control everything. You control less and less of the sphere of the pitch you're trying to achieve. Influence is key. How do you build that cross-functional coalition? How do you drive performance improvement today while designing a better to-be for tomorrow? and this whole challenge between improving the process and leading with technology. When is it right? When is it wrong? How do we do that? And of course, human behavior and human habit has a massive impact, however digitized we may or may not be. So another question for you. Who leads intercompany in your organization? Is it 1, the controller or accounting in general? Is it 2, treasury? Is it 3, a dedicated intercompany process owner? 4, is it record to report process owner? Or 5, another? And if you don't know the answer, it's 5, obviously. But so 1, who leads intercompany in your organization? The controller or chief accounting officer? 2, treasury. 3, a dedicated intercompany global process owner. 4, record to report process owner. 5, another. So, and as I say, if you don't actually know who leads it, it's okay to go for 5. So let's have a look at the old scoreboard. So we have a dedicated, that's good to see, the dedicated intercompany process owner is leading the scoreboard there. So congratulations to all of you, and record to report very close behind. That's kind of interesting. Actually, it's a slightly better result on the intercompany process owner than I might have expected. So well done, good. And one more question for you. Don't worry, it's the last one. Then you're going to be asking us questions. So in your organization, who is most impacted by the intercompany challenges? Is it 1, the CFO controller, 2, treasury, 3, tax, 4, shared services or GBS, or 5, other? So who's most impacted by the challenges in intercompany, the intercompany process? Is it 1, the CFO controller? Is it 2, treasury? Is it 3, tax, 4, shared services, or 5, other? So if you don't know, we're not sure, just 5 is good. But which of those roles in your organization is most impacted? Let's have a look at the old scoreboard. So it is shared services, okay, and followed by CFO controller. Yeah, that's interesting. Surprise treasury so low, but that's great. Thank you very, very much for that. So we'll move on. So we talked about this idea of global process and the challenge between process and technology-led change. One thing I just want to share, because this always makes me laugh, but it's so true, right? We are constantly led to this idea that we apply technology that's going to really drive us forward in the right direction. But the first rule of any technology is that automation applied to an efficient operation will magnify the efficiency. But the converse is automation applied to an inefficient operation or process will magnify the inefficiency. Well worth thinking about, which tells us we better make sure our process is right before we deploy the automation. And somebody I know who feels a similar way is Steve Standring. So I'm going to hand over to you, Steve, to give us your view about intercompany financial management. Steve.
Thank you very much, Dan. So I'm going to try and get across the concept of moving beyond just zero and intercompany. And I think the first thing to think about here, particularly if you're looking at this from a GPO perspective, is you almost have to consider this process end to end. And that means the impact on accounting, the large number of transactions and how very manual it often is, but also tax. Do you have agreements in place? Are you compliant in all jurisdictions? Can you defend your transfer pricing rules? And lastly, treasury. Are you losing money through foreign exchange? And the number of transactions you make to settle your intercompany deals. So moving on, I think it's worthwhile spending a little bit more time on the strategic impact. And this would be, I wanted to do this a little bit because it'll be the beginning of anybody's business case, I guess. So the first thing around efficiency, we look at efficiency a lot in shared services, but growing intercompany pains, it impacts staff efficiency in a massive way. 99% of companies we surveyed have got people pulling all-nighters to close the books because of intercompany, and that leads to massive churn of people, just makes life really difficult. And it's not just that it eats up all of finance's time and their capacity, it also means we're less agile as a company. It takes longer to move data to tools and teams that need it. Think about your company, culture and dynamic. Are you acquisitional? Are you changing your business structure? Are you ready for an intercompany audit? There's always a sweaty question. What are your big projects? All these things are going to impact your people and how they spend or don't spend their time. As far as tax is concerned, how do you defend intercompany decision-making in your charges? To go higher up on the defensibility scale, you need more granular charges and a clear intercompany audit trail. But these more granular charges fly in the face of a fast and efficient close. So you can start to see why controllership and tax teams can clash. This really impacts your bottom line, surprisingly. Intercompany charges are often lump amounts, and as it's hard to manually capture costs with the right categorization at the right level of granularity. And when you're not booking line items and don't have granular level data, it's much harder to analyze and determine business performance, as Dan mentioned earlier. This also impacts Treasury, who need to roll up and settle invoices as part of the billing and collection process. So receiving a timely netting report is really important to manage intercompany financing and gain visibility on liquidity and foreign exchange exposure. If you look at the whole process, therefore, you can see that it's got large consequences to lots and lots of different stakeholders. So we try to look at this thing as a new category, which we call intercompany financial management, and it's really just the centralization of the process and optimizing it first to give you full visibility and full automation of that process as far as possible. So IFM supports the whole integrated end-to-end process. It'll also take you beyond zero, as we like to say, and support the business's strategic goals. For example, mergers and acquisition, which Dan also mentioned earlier, but also the optimization of working capital, which is crucial to business strategy. And that means improved liquidity and business margins. So we're not just talking efficiency saving, but reduced tax leakage, optimized transfer pricing, reduce foreign exchange risk, better analysis of divisional cost to help improve profitability, and so on. It drives operational excellence with control of the processes, and that means agreements in place and visibility of all transactions to defend any behaviors. And it also means reporting and insight from summary information right down to line level. And of course, lastly, it needs to enable a world-class finance efficiency in a controlled and compliant process. So it starts with optimizing your processes. So if you're thinking of doing an S4 HANA or Oracle upgrade, the technology isn't going to fix this without looking at the process first. I mean, we all know that you optimize processes before you automate. It's just that we don't always do it that way. So, and that has to include how you integrate to tax, treasury, and transfer pricing. Financial execution in the middle here is really about the usage of technology, and that's where Blackline fits in along with people like Oracle and SAP. Now, just looking now at some hints about how to first start addressing this from an automation perspective. We spent about 15 years trying to figure this out, because this was not easy, because when we start looking at this from a technology basis, you can't fix this easily. So here are the crucial things. Categorize your invoice types first. Here are some examples here of the kind of category invoice types that you might see, but categorizing them first, you've got to pre-agree the calculations between business divisions, and then that allows you to be able to define the invoice journey in a configuration engine. And this begins to make sense, doesn't it? If you know where an invoice starts and where it ends, it's quite easy to figure out how you apply tax transfer pricing and treasury rules to that invoice. And that's exactly how we look at automation of this. Now, you'd be amazed how many of these categorized invoice types take the same journey every time they go out. So we reckon you should get to about 95% automation as far as this is concerned. And because we are initially connecting to all the different data sources, you may have multiple billing engines, you may just have one. Once we create the invoice, we are also connected into data sources like tax, transfer pricing, and treasury. And as I said, because we know the journey those invoices are taking, we can apply those to the creation of the invoice. And that means that those invoices can get posted immediately, simultaneously in AR and AP journals. And that means there are no out of balances, nothing to resolve, and no exceptions. There are always going to be some exceptions that you need to workflow and manage after the fact, but we believe that those should be down at well below 5%. And this allows us to have, just data consolidated in one place. And that means that we can help with settlement, netting and settlement to support Treasury's aims and goals. So insight-wise, here are some hints that we're just going to flash through very quickly, but this should mean that you can get summary information on any aspects of the intercompany process down to detailed information as you want to slice and dice it And I think that's pretty exciting. It's not really been, I've never seen companies be able to do this before. So you can highlight areas of risk and just, as I said, slice and dice the data as you need to run your business better. So the idea of this is to get away from the horrific situation we often see now with increased staffing demands, reduced finance and accounting capacity, costs showing up in the wrong places, out of balances going on for decades, finger pointing, people pulling all-nighters and leaving, you name it. We're seeing slow close processes because of the intercompany process, which is why people are beginning to look at it now. And it means now, looking at IFM, you can start thinking of optimizing finance capacity, strategically touchless, make sure that your transfer pricing compliant and tax compliant. You can connect ERPs together and run this process. So if you've got a consolidation exercise, at least you've got this process managed and it won't change as you go forwards. This lives with you and scales with you as you go forward in your business, whatever the changes are. You've got end-to-end transparency and it's centralized and managed. So just to finish off very quickly, I thought it'd be worthwhile looking at a little case study. So we're finding that with this kind of approach, we're improving operational efficiency by more than, we've got 50–60% here, but that's quite conservative. We're looking at 60% reduction in days to close while decreasing write-offs by 80%, but we're also looking at cutting operational cost from a perspective of manual work by up to 80%. Managing global tax compliance is getting more complicated. More and more countries are looking at invoice mandates. There are the taxes like the BEAT tax in the US that we're going to see more of those as countries try and recoup tax dollars post-COVID, I imagine. And this does drive margin improvement. We've discovered that on average, we find about $1 million worth of tax leakage for every 2 billion of intercompany volumes. So there are some significant benefits in tax reduction, reducing tax leakage, and finally, just optimizing working capital. Not only just reduction of payments and foreign exchange and settling much faster, but just the ability to, if you've got loan accounts running between businesses and the rest of it, you can start optimizing working capital significantly better. So those are the kind of benefits that the business would get from heading towards IFM. And I hope that's been a useful overview, and I'm going to pass back to Dan.
Thank you very much, Steve. That was a really insightful, if not rapid fire, route through intercompany financial management from your experience. So thank you so much. This is a good time to post your questions. So there's definitely some questions around that. So use the GoToWebinar interface and pop your questions in, and we'll deal with them at the end. So I'm going to kind of bring this to a close with some thoughts now about how you take this forward. So just reminding ourselves, this intercompany end-to-end process, we've got to understand it end-to-end. And yes, the closing, reconciliation, and reporting piece is a big part, and it's where a lot of the pain is. But as in most end-to-end processes, the reason it's so painful on the right-hand side is we don't really get it clear further to the left. So rule number one, we've got to focus on that. And we've got to remember this point. If you are lucky enough to be an intercompany global process owner, you know why you're doing it. If you don't have one, whoever is responsible for this, you've got to make sure you're focusing on this, how to eliminate the silos. And whatever you do, and Steve talked a little bit about this, you've got to start with why. What does good look like? It's not as obvious as people like to think. And in fact, it doesn't matter whether it's intercompany or any other process. Why do we do this in our business? And what does good look like? Is a tough question, and you need to ask your stakeholders and the BU leaders and make sure you got a clear understanding of that, because then you can get into the what, the people, the process, the technology, and the data. And then the how, which is the process we've talked about. Make sure we understand the end-to-end process, but also this idea of journeys. There's no one route through intercompany. There are a whole host, and even the best intercompany cycle has got a number of journeys through it. And there's some examples there. So you've got to be able to map those out and work out what they really mean. And of course, we need data. We need to be able to look at all our kind of intercompany invoices, categorize them by type. What sort of intercompany transactions are these? Categorize them, both by type and by company. So that helps us both help define the journeys, but also help define the business case of where the effort is going for the scale of transactions we're processing. So when you think about optimizing a business process, it's no surprise, we've talked about this already, but we've got to analyze the process, the as is and the to be, adjust the process the way we want it to be, and then automate. So I think we've talked about this. It's a pretty clear model, and I do encourage you to think about that. In terms of doing this, we're looking at defining, measure, analyze, improve, control, the classic cycle, but you want to think about how do I build a stakeholder coalition? What's the governance over the process? If we don't have a global process owner, what is the governance model? What does good look like? Define the process, define the journeys, as is and to be, understand the data, and then look at digital, and then accelerate to your to be model. And that's really the sequence you want to go to. And in terms of helping you get started, the kind of things that we can do and Blackline can do is help you in this top level piece, build that powerful coalition, start with why, make sure that's clear and everyone's bought into it. Identify and map those end-to-end process views, the core data and the journeys, and use the data to understand the as is, as well as help you build a route to the foundation of the to be, because data is king. So data tells the story, and I kind of indicated that already with the invoice categorization, and use all that to support and build a business case. So I think this is this is as true in intercompany as is in any other field of endeavor. Don't let the great be the enemy of the good. It's easy to fall into these red line strategic multi-year initiatives, but our expectations are beyond that. We've got to find ways of delivering 80% of the value for 20% or less of the effort, cost, and cycle time, and deliver these Pareto principle initiatives that are all above the line, all delivering incremental value, and you can do it. So one comment, obviously, about the whole, whether it's intercompany or any other end-to-end process, we don't control everything. Much though we might like to, we don't control everything. There's more influence required than control, which means that as we build our teams, as we build the organization, we've got to make sure we've got at least as much EQ as we have IQ, preferably more. So EQ is the key, build relationships, form the coalition, and drive to success. So in summary, why think different about intercompany? Steve's talked about it. I've talked about it. You can improve efficiency dramatically. That's a big part of the focus today. But we've got these other issues as well: improving tax efficiency, improving margins, improving working capital, cost transparency, auditability, which again, massive issue. And we know there's a big difference between the best and the rest. This is probably one of the most exposed processes for maximum improvement, and it's getting more complex with regulations changing and the global landscape shifting. So if you're thinking about this, that's why you want to think differently. So that's what we've talked through. I want to just now take your questions. So if you haven't asked already, keep asking them. Let's see what we got here. So Steve, I'm going to get some questions out. So we've got questions now. So we've got a couple of minutes. So we've got, right. Here's a question. Right. You mentioned S4 HANA. We are moving to S4, which will give us a single instance ERP and a single set of ledgers. Isn't this another way to address the intercompany problem? Steve, what are your thoughts on that?
There you go. I knew I shouldn't have mentioned S4 HANA. I think the answer to this is moving to a single ERP from a strategic point of view is obviously going to help as far as managing your data and centralization. But SAP doesn't manage a process as such, end to end. I think it would be probably unwise to not optimize let's put it another way. You've got an opportunity to optimize your intercompany processes before you start looking at HANA. If you look at the solutions in something like S4, they focus very much on giving you visibility of things that don't match and don't balance. What they don't do is try and fix everything upstream so that you don't have any things that are out of balance. That's a massive difference in approach. So that'd be one thing to say. You've got to optimize the process first. And the second thing to say is, and this is just technical, HANA S4 does not support your non-trade intercompany invoices, right? Because they don't go through AR. And that's one of the reasons that SAP have partnered with Blackline and resell this solution to their customers. Have you got anything to add to that, Dan?
I think you've said it all. I mean, I probably had a couple of comments that you probably already made, so that's great. That's fine. Let's have another one. Time for one more. How do you build the business case, Steve?
Well, I suppose we've touched on some of you've got to look at the efficiency gains, obviously, and you've got to look at the strategic benefits too. I would say the first place to start would be to look at where, I mean, like any other business case, I suppose, where all your people are spending their time, because that's also introduces where you're introducing risk. But you also want to start looking at where they're not spending time where you would like them to. Now, I would do that in conjunction with mapping out your current intercompany processes, looking at where the data sources are, look at where the manual touch points are, look at where you integrate into tax, treasury, transfer pricing, we get to grips as far as that process is concerned, and see how that compares against IFM as best practice, and look at the consequences of moving to something like IFM, and that will give you your value proposition. But I would also add into there something around connecting any business case with your wider financial goals, so that you're supporting what the business is trying to do at the moment. And that's always a nice thing to do in a business case, and sometimes we don't. We focus just on cost savings and forget to associate what we're doing to some of the wider goals. So that's how I would start, and I would start by looking at maybe one of your two representative processes, one in trade and one in services. This is your area of expertise though, Dan.
Makes sense. I agree with you. I think that kind of process and journey mapping thing is absolutely key. You get feedback from stakeholders and business units, you get clear about where the effort is, you get clear about the current cost structure and the current current impact of the failures and the weaknesses in the process. And then you want to look at the data, the intercompany invoice population. You can do that automatically. You can look at where the effort's going based on between companies, use that to categorize the journeys and give you a real basis of where the wins are. And then that will tell you whether you have a business case to play for or not. But I think, as you say, Steve, in most large companies, there's a lot of opportunities for improvement. So I'm conscious of time. We're just over the 30 minutes. Thank you very much for your attention and for your questions. And if you've got any more questions, pop me an email and I'll discuss with Steve and we'll get back to you. We will take the questions that are in the GoToWebinar and we'll get back to those of you who didn't get the opportunity to respond to. Thanks very much. Enjoy the rest of your day. I hope you found it thought-provoking and useful, and best wishes. Thank you.
Yeah, thank you, everybody.